let's get deep into our stock debate of the day. The question we're putting to you and to our guests: do you agree with the Bank of America Merrill Lynch view that the ICICI Bank stock can double in 3 to 4 years? Joining us to debate that, Anand, Tandon and Ajay, Bagga. Gentlemen, it's only fair that I read out for you a bit of the rationale for why Bank of America Merrill Lynch thinks that this stock can actually double in 3 to 4 years. They've said that ICICI Bank's profitability has improved sharply in the past 5 years, but trades at a 5-year P2B cycle average and large discount to many peer banks. We think that is set to change, and the stock is likely to re-rate as the ROE rises from 14% to 18% by FY18. They believe that it's relative to peers, it is the cheapest private bank with comparable returns, providing best risk reward. That's the rationale for why they think the stock can double in the next 2 to 3 years. Ajay, would you agree with that?
I would agree. If you look at the kind of drivers that are embedded in the stock, there is a good chance that you could see a doubling of this stock in the next 3 to 4 years. I would say nearer to 4 years on a mathematical basis, but probably on a sentimental basis, you'll get nearer to 3 years.
Anand, any stock that is seen as a proxy to the Indian economy, and ICICI Bank would certainly fall in that category, is expected to do well if the India story is going to be as shining as most people seem to think. But does ICICI stand out in any way, both from a valuation point of view and performance?
Well, as you mentioned, the valuation relative to the other private sector banks is a little lower, not very substantially, but even then it is lower. And there is no doubt that over the last few years, ICICI Bank has managed to get its act together. There was an overemphasis on the assets that they had put up overseas, which were not really performing, still aren't performing really. And, the bank has been struggling to get some of that money back. So a lot of effort has been spent in terms of trying to get the domestic franchise back up again. A lot of investment has been made in branch expansion and so on. The assumption that it will bear fruit is reasonable, assuming that nothing dramatic happens with the competitive scenario. So the real joker in the pack has to be that whether or not the public sector banks also wake up, given the fact that the government seems to be in the mood to shake up the organizational structures even there.
Okay. Public sector banks, new licenses for public sector banks, how much can they really wake up given the fact that they are, whatever they do, they're hugely capital starved? And will the government infuse that much of capital into public sector banks?
Senthil, I think that is very relevant. It's a very weak balance sheet for public sector banks, and there's really no clarity on how the capital will be raised. The government has said that they will be free to go to the market. There's talk of a holding company structure being created, which will own all public sector banks. But given the combination of low capital or a weak capital base, a need for more capital raising with no clarity, second, the NPL situation at public sector banks, and third, overall, we have just seen 6 CMD level posts, the whole process being cancelled and being relooked at. I think all that is what drives the negatives towards public sector banks. I would say more private sector banks as a sector preferred. Within that, I think ICICI stands out well. One is it's virtually adding 500 to 600 branches a year. It's nearly equivalent to smaller private sector banks. If you look at the balance sheet, it is still not having too much exposure to the SMEs within the corporate book. The NIMs are lower than the market leaders, say like an HDFC Bank. There is option to improve on that, and it's a borrower in the market. If you see its overall book, it borrows nearly 14% of its funds, vis-a-vis say an Axis or an HDFC Bank, which would be at in the 5 to 6% range. So as the cost of borrowing comes down, it can be a beneficiary, and a very sweet spot. It has got huge capital. It really does not need to go back to the market for the next 2 to 3 years at least for fresh capital. So any growth is going to be book value accretive, and you're going to see an impact on the stock price.
Anand, what would be your pecking order? Because you have among all the large cap private sector banks, the HDFC Bank stock, which has actually underperformed the most because of the FIPB issue and the foreign shareholding issue. Would you play it via that, or would you play it via a stock like, say, IndusInd Bank, which has been the best performing stock but easily the most expensive banking stock? I mean, it's really curious. The more expensive the stock, the higher the rally over the last 1 month or so. What would be your pecking order in the private sector space?
Well, I think ICICI Bank is probably the least controversial of the lot because, as Ajay pointed out, there are a lot of triggers there which could re-rate, and assuming that the basic underlying economy does well and, you don't have new restructuring of assets or loans, and you don't have any issues that pop out which have not already been cited, you should expect to see improved efficiency, you should expect to see better CASA ratio, you should expect to see margins therefore increasing, cost income ratios improving, and so on. So I would think that ICICI, and it is, as you mentioned, it's relatively the cheapest stock among the whole private sector scenario. The only other stock which I think, of course, very expensive, but which will perhaps equally benefit from the market, especially the capital markets, is probably the Kotak Bank, right? It's also very expensive, more so than perhaps the rest of the peer group, but it also is the best leveraged among those in terms of the capital market exposure, and has a very, very conservative balance sheet, a lot of capital to go, and can continue to increase. The key point is whether you expect to see credit growth happening quickly or not. I mean, we are right now struggling with almost a single-digit credit growth, which is not great for any banking system. The entire leverage assumes that you are going to go back to 17-18% or more credit growth, and these banks will all benefit from there.
This question goes to both Anand, you and Ajay, and I'll come to you, Anand, first on this here. The Bank of America Merrill Lynch report says in a scenario where multiples sustain, the stock may double in 3 to 4 years. My question to you is this: if the overwhelming mood currently is in favor of financials and the belief that financials will benefit the most and the first from an upturn in the economy, which is probably 2 quarters away from now, do you think that there's a chance that multiples, in fact, may accelerate much faster than even this report anticipates, and therefore we could look at a doubling of the stock in, let's say, a 2 or 3 year horizon, or would that be overly optimistic?
Menika, anything is possible. At the end of the day, when you have a bull market, valuations do tend to move faster than you would anticipate. I think the basic argument being made is 18% growth, sustained valuation, which is at the lower end of the band. You would expect to see doubling in 4 years. If any of those factors change, obviously, to the positive, it could move up faster. You have to remember that in the last 5 years, for example, it has gone up only 50-60%, most of which is in the last few months. So it is not as if these stock movements are linear, but the valuations would certainly suggest that a 4-year doubling is entirely possible.
Would you, Ajay, see that valuations for the entire sector will move up beyond current estimates dramatically, and therefore, relative to that, ICICI Bank will probably do it in less than 4 years? Because I know you said 4 years seems more realistic right at the beginning of this conversation.
Yeah, Menika. As I said, if you look at the EPS growth that we are factoring in, as against an 85 rupees for the last year, we are looking at a 14-15% accretion this year, and factoring in about 20-21% growth for the next 3 years, from FY16 to FY18, is the kind of growth that we are forecasting for ICICI Bank. So you are looking at EPS virtually doubling from 85 rupees of last year to about 170, 175. Now, in this, if you add in the 8-9 odd subsidiaries that the bank has, their contribution in the share price today would be about 250 rupees on a 1600 odd share price. That can also get added on. That is after a holding company discount of say 20-25% that we normally put in. So a lot of drivers going for ICICI Bank, and it's coming off a lower valuation than peers. The other thing is that it has a lower share of retail loans than Axis or HDFC Bank. So as the economy improves, it has a lot more to gain from restructured assets doing better, or if infrastructure assets start performing better. Its restructuring book right now, the flow through into write-off is about 12.5%, which is overhang on the stock, and that's why it gets a lower valuation, given its corporate book and given its exposure into the infrastructure sectors, which have been seeing some amount of stress. As those get worked out and as those get revived, it will be a natural beneficiary. So we are positive on this.
All right, so there we have it. Both our market experts in cautious agreement with what Bank of Merrill Lynch has put out as a possible scenario of the stock doubling over the course of the next 3 to 4 years. That is, of course, if all goes well with the economy and the banking sector.